Warren Buffett, one of the greatest investors of all time, has a simple instruction for his estate. Put 90% of his wealth in index funds. Not individual stocks, not actively managed funds. Index funds. If the world's most successful stock picker recommends index funds over picking stocks, what does that tell you? Index funds are the investment vehicle that built more millionaires than any other strategy in history. They're also the most misunderstood. People hear index fund and their eyes glaze over. Sounds complicated, sounds boring. It's not complicated. It's actually the simplest, most effective way to build wealth through investing. Today, I'm going to explain exactly what index funds are in plain English, why they beat almost everything else, how to actually use them, and the specific index funds you should buy. No jargon, no complexity, just the clear path to wealth that the financial industry doesn't want you to know is this simple. Let's get into it. Let me show you three people who all avoided index funds and paid the price. Person 1. Marcus, the stock picker. Marcus is 34. 10 years ago, he started investing with $10,000. He read books about stock picking, followed financial news, analyzed companies. He was convinced he could beat the market by selecting individual stocks. Over 10 years, Marcus picked dozens of stocks. Some winners. He bought Apple and it did well. Some disasters. He bought a tech startup that went bankrupt. Some mediocre. Lots of stocks that just sat there doing nothing. He spent hundreds of hours researching, reading quarterly reports, watching CNBC, stressing about earnings announcements. After 10 years, his $10,000 is now $23,000. That's a 130% return, or about 8.7% annually. Not terrible. But here's the thing. If he'd just bought an S&P 500 index fund and never touched it, that $10,000 would be $34,000. That's a 240% return, or about 13% annually. Marcus underperformed the market by almost 5% per year. Over 10 years, that cost him $11,000, plus hundreds of hours of wasted time he could have spent building a business or working a side hustle. Marcus thought he was smarter than the market. He was wrong, and he paid for it. Person 2, Jennifer, the financial advisor victim. Jennifer is 42. 15 years ago, she went to a financial advisor her parents recommended. She had $30,000 to invest. The advisor put her in actively managed mutual funds and charged her 1% per year to manage it. The advisor promised to beat the market through careful stock selection and market timing. Jennifer trusted him. Every year, she paid 1% of her balance in fees. Every year, the funds underperformed the S&P 500 by about 2% on average. After 15 years, Jennifer's $30,000 is now $98,000. Sounds good. But if she'd invested in a simple S&P 500 index fund charging 0.03% fees instead of actively managed funds charging 1% fees, she'd have $165,000. The difference? $67,000. That's what trusting a financial advisor to beat the market cost her. The advisor made tens of thousands in fees. Jennifer lost $67,000 in opportunity cost. She paid someone to make her poorer than she would have been doing nothing. Person 3, David, the analysis paralysis victim. David is 29. 5 years ago, he decided to start investing. He had $5,000 saved. He knew he should invest it, but he couldn't decide what to buy. Should he pick stocks? Which stocks? Should he buy mutual funds? Which ones? Should he buy ETFs? Index funds? What's the difference? So he researched and researched and researched. He read blogs, watched videos, joined Reddit forums. Everyone had different opinions. He couldn't decide. I'll just research a bit more before pulling the trigger. 5 years later, that $5,000 is still sitting in his savings account earning 1% interest. It's now worth $5,250. If he'd just bought an index fund on day one and stopped overthinking, it would be worth $8,900. He lost $3,650 to analysis paralysis. David was waiting for perfect knowledge before acting. Perfect knowledge never came. His money sat idle for 5 years. The common pattern. All three of these people made the same fundamental mistake. They thought investing had to be complicated. They thought they needed special knowledge, active management, or perfect understanding before investing. They were wrong. The simple truth that nobody wants to tell beginners, just buy an index fund and hold it forever. That beats almost everything over long periods. It beats stock picking. It beats financial advisors. It beats overthinking and waiting. But people resist simplicity. They think it can't be that easy. Or they fall for financial industry marketing that makes investing seem complex, so you'll pay for their services.
Let's break down exactly what index funds are and why they work so well. What is an index fund? The simple explanation. An index is just a list of stocks based on some criteria. The S&P 500 is an index of the 500 largest U.S. companies. The total stock market index is every publicly traded U.S. company. The NASDAQ 100 is the 100 largest non-financial companies on the NASDAQ exchange. An index fund is a fund that owns all the stocks in a specific index. When you buy one share of an S&P 500 index fund, you're buying a tiny piece of 500 companies all at once. When you buy a total stock market index fund, you're buying a tiny piece of about 3,500 companies. That's it. No stock picking, no active management. Just own the whole market. Why index funds work. The math. Here's why index funds beat almost everything. Reason 1. Diversification. When you own one stock, your fate is tied to one company. If that company fails, you lose everything. When you own 500 stocks via an index fund, if one fails, you barely notice. You're not betting on individual companies, you're betting on the entire economy. Individual companies fail all the time. Blockbuster, Sears, Enron, countless others. If you owned those stocks, you lost money. If you owned an index fund, those failures were tiny blips. The index replaced them with new companies and kept growing. Reason 2. Low costs. Index funds charge expense ratios of 0.03% to 0.20% per year. That means for every $10,000 invested, you pay $3 to $20 annually. Actively managed funds charge 0.50% to 2.00%. For $10,000 invested, that's $50 to $200 per year. Over decades, that difference costs hundreds of thousands. Example, invest $50,000 for 30 years at 10% returns. Index fund at 0.03% fees ends at $872,000. Active fund at 1% fees ends at $743,000. The difference, $129,000 lost to fees. Same investments, same time, different fees. $129,000 difference. Fees destroy wealth. Reason 3. You can't pick winners consistently. Research shows that only 4% of stocks account for all the market's gains over time. The other 96% either lose money or underperform cash. When you pick individual stocks, you're trying to identify that 4%. You'll almost certainly fail. When you buy an index fund, you automatically own that 4% plus everything else. You don't need to identify winners. You own them all. Reason 4. Beating the market is nearly impossible. Over 90% of professional fund managers underperform the S&P 500 over 15-year periods. These are experts with teams, resources, and inside information. They fail to beat the market. You, with a Robinhood account and some free time, will not beat professional fund managers who can't beat the market. Accept this. It's liberating. Index funds guarantee you match the market. That's enough. The market returns about 10% annually over long periods. That doubles your money every 7 years. That's incredible wealth building. Reason 5. No decisions required.
With index funds, there are no decisions. You don't pick stocks, you don't time the market, you don't worry about when to buy or sell. You just buy and hold forever. This removes emotion from investing. Emotion destroys returns. When the market crashes, emotional investors panic sell. Index fund holders just keep holding. When it recovers, it always does, they profit. Emotional investors locked in losses. Types of index funds. There are three main categories. Type 1, broad market index funds. These own the entire market or large chunks of it. Examples: Total Stock Market Index owns about 3,500 U.S. companies. Every size, every sector. You own everything. S&P 500 Index owns the 500 largest U.S. companies, about 80% of total U.S. market value. Total International owns companies outside of the U.S., provides global exposure. For most people, one broad market index fund is enough. Just own everything. Type 2, sector index funds. These focus on specific industries. Examples: Technology Index Fund, Healthcare Index Fund, Energy Index Fund. Generally unnecessary for beginners. Broad market funds already include all sectors. Sector funds are for advanced strategies. Type 3, bond index funds. These own bonds instead of stocks. Lower returns, lower volatility. Used for stability as you age or for conservative portfolios. Example: Total Bond Market Index. Most beginners should focus on stock index funds. Add bonds later when you're closer to retirement or want less volatility. Index funds versus ETFs. What's the difference?
Index mutual fund. Bought and sold once per day at market close. Minimum investment often required, sometimes $3,000. Purchased directly from the fund company. Index ETF, exchange traded fund. Bought and sold any time during market hours, like a stock. No minimum investment, can buy one share. Purchased through a brokerage. Both track the same indexes, both have low fees, both work great. The difference is mostly technical. For beginners, ETFs are often easier because there's no minimum investment. Common Index ETFs. VTI, Vanguard Total Stock Market. VOO, Vanguard S&P 500. SPY, SPDR S&P 500. All track the same market. All work. Pick one and move forward. How to actually use index funds. Here's the simple strategy that works. Step 1. Open a brokerage account. Go to Vanguard, Fidelity, or Schwab. All are excellent. Open an account. Takes 15 minutes. Step 2. Choose your index fund. For most people, pick one of these: Total Stock Market Fund, VTI if using ETFs, VTSAX if using mutual funds. That's it. One fund. Don't overcomplicate. Step 3. Buy and hold forever. Buy shares with whatever money you have available. Set up automatic monthly purchases, then leave it alone. Don't sell when the market drops. Don't try to time it. Don't check it daily. Just keep buying every month and hold forever. Step 4. Reinvest dividends. Index funds pay dividends, profits from companies. Set your account to automatically reinvest these. This compounds your growth. The asset allocation question. Should you own 100% stocks? Should you add bonds? Should you include international? For beginners under 40, 100% total stock market or S&P 500 indexed fund. You don't need anything else. You have decades to recover from crashes, maximize growth. For intermediate, 40 to 55, 80 to 90% stocks, 10 to 20% bonds. Still mostly growth, slightly more stability. Example: 80% total stock market, 20% total bond market. For pre-retirement, 55 plus, 60 to 70% stocks, 30 to 40% bonds. More stability, less growth. Protecting wealth becomes more important than building it. International exposure. Optional. Total U.S. market already includes companies with international revenue. If you want explicit international exposure, add 10 to 20% total international fund. Not necessary, but not harmful. The key, keep it simple. Most people don't need more than 2 to 3 index funds total. Common mistakes to avoid. Mistake 1. Buying too many index funds. People think they need 20 different funds. They don't. One total stock market fund gives you everything. More funds doesn't equal better diversification. It just creates complexity. Mistake 2. Trying to time the market. I'll wait for a crash to buy. Bad idea. You can't predict crashes. Trying costs you money. Just buy consistently regardless of market conditions. Mistake 3. Selling during crashes. The market will crash, maybe 30%, 40%, 50%. Don't sell. Every crash in history has been followed by new highs. Selling locks in losses. Holding lets you recover and profit. Mistake 4. Chasing returns. This sector fund returned 30% last year. Don't chase. Last year's winners are often next year's losers. Stick with broad market funds. Mistake 5. Paying high fees. Never buy an index fund with fees over 0.20%. There are excellent funds at 0.03%. Don't overpay. The proof, real returns. Let's look at actual historical returns. S&P 500 Index Fund. 10-year average return, about 13%. 20-year average return, about 10%. 30-year average return, about 11%. What that means in dollars. Invest $500 per month for 30 years at 10% annual returns. Total contributed $180,000. Ending balance $1,013,000. Growth $833,000. Just buying an index fund and holding created over $800,000 in growth from $180,000 in contributions. Compared to active management, same $500 per month, but in actively managed funds averaging 8% after fees. Ending balance $745,000. Difference $268,000 lost to underperformance and fees. Index funds aren't exciting, but they work consistently over decades.
Here's your exact action plan to start using index funds today. If you're a complete beginner, today, open a brokerage account at Vanguard, Fidelity, or Schwab. Takes 15 minutes. This week, transfer money to your new account, even $100 to start. This month, buy your first index fund, VTI or VOO, one or the other, not both, just one. Going forward, set up automatic monthly investments. Whatever amount you decided to invest monthly, automate it into your index fund. Forever, hold, never sell. Keep buying monthly. Ignore crashes, ignore hype, just hold. That's the entire strategy. 5 steps, done. If you already have investments, step 1, look at what you own. Individual stocks, actively managed funds, high-fee products. Step 2, calculate the fees you're paying. If you're paying over 0.20% annually, you're overpaying. Step 3, consider simplifying. Sell the complicated stuff. Move it to index funds. You'll likely improve your returns and reduce stress. Step 4, if you have capital gains concerns, do it gradually, but eventually simplify to mostly or entirely index funds. The Buffett Challenge. Warren Buffett famously made a bet in 2008. He bet $1 million that an S&P 500 index fund would beat a selection of hedge funds over 10 years. Hedge funds are run by the smartest investors with unlimited resources, advanced strategies, and insider access. They charge 2% fees plus 20% of profits. Buffett's simple S&P 500 index fund crushed them. The index fund returned 125.8% over 10 years. The hedge funds averaged 36.3%. The world's most sophisticated investors, with every advantage, lost badly to a boring index fund. If they can't beat it, you can't either. And you don't need to. Just match it. That's enough. Your specific next steps. Pull out your phone right now. Don't wait. Step 1. Go to Vanguard.com, Fidelity.com, or Schwab.com. Step 2. Click Open an Account. Step 3. Choose Individual Brokerage Account or Roth IRA. Roth IRA is better for most people. Step 4. Complete the application. Social Security number, bank info, employment details. 15 minutes max. Step 5. Once approved, usually same day or next day, link your bank account and transfer money. Step 6. Once money settles, 2 to 3 days, search for VTI or VOO and GUI. Step 7. Set up automatic monthly investments for whatever amount you decided. Done. You're now an index fund investor. You're on the path to wealth. The simplicity is the point. People resist index funds because they seem too simple. There must be a catch. There's no catch. It's just math and diversification. The financial industry doesn't want you to know it's this simple because they can't charge you fees for simplicity. They need you to think investing is complicated, so you'll pay them to do it. It's not complicated. Buy a total market index fund, hold forever, build wealth. The alternative? What's the alternative to index funds? You could pick individual stocks, spend hundreds of hours researching, underperform the market by several percent per year, miss out on hundreds of thousands in growth over decades. You could pay a financial advisor 1% annually, let them underperform the market, pay them tens of thousands in fees over your lifetime, end up with significantly less money. You could do nothing. Let your money sit in savings earning 1% while inflation eats 3%, get poorer every year despite saving. Or you could buy an index fund, spend 15 minutes setting it up, spend 5 minutes per month adding money, beat 90% of professional investors, build significant wealth over decades. Which option makes sense? Final truth. Index funds are boring. They're not exciting. You won't have stories about the stock I picked that went up 500%. You won't feel like a Wall Street genius, but you'll be wealthy. Slowly, steadily, surely wealthy. Boring beats exciting in investing. Consistency beats cleverness. Simple beats complex. Index funds are boring, consistent, and simple. That's exactly why they work. If this video made you understand that index funds are the smart choice for most people, hit that like button. If you want more honest financial education that cuts through industry BS, subscribe and turn on notifications. Share this with anyone who's confused about how to invest. This simple strategy works. It's been proven over decades. It beats almost everything. Index funds explained simply. Buy them, hold them, get rich slowly. That's it. Now go do it. I'll see you in the next one.